Hi, today we are going to talk about options, or rather plain vanilla options. We need to get our basics right, so let's start with defining what's the options. Option is a financial instrument where the buyer has the right to exercise if the price is right. So for this right to exercising, the buyer has to pay a premium to earn this right. And for every buyer, there's a seller. So the seller is obliged to fulfill this right, the buyer's right, if the buyer exercises. And for this obligation, the seller receives a premium. Okay, so there are two types of options: the vanilla options and the European options and the American options. European options can be exercised upon expiry only on the expiry date, while American options can be exercised anytime from the date of entering into the options until expiry. Okay, so let us move into the notion of valuing an option. So basically the question is, how do we calculate this premium where the buyer has to pay the seller to earn this right? Okay, so there are a few parameters that goes into the calculation of option premium, and so these are the five. They are the current spot price, the time to maturity, the implied volatility, which means that the volatility implies by other options that is being traded in the market, volatility of the spot price. Okay, the current risk-free rate, and of course the strike price, which you agree with the buyers, with the seller. There are certain Greeks that measures the change of all these parameters and the impact on the premium, and these are again plain vanilla basic Greeks. There are higher order Greeks which we are not going into for now. Okay, for the plain vanilla Greeks, there are the delta gamma, which is measuring the change in the premium when spot price change. Okay, gamma is basically a higher derivatives of delta. Theta is a derivative measuring the time. Okay, vega is measuring on the volatility. Rho is measuring on the risk-free, and lastly, because the strike is a fixed number and it doesn't change throughout the life of the option, there's nothing to measure, so there's no grade for the strike price. Okay, I've mentioned all these things. I think it's best to talk about the whole concept of option using an example. Okay, so I have this example here where let's pretend that this is a equity option. Strike price 50, current price 40, 6 months to maturity. Okay, so assume that this is a European option. We always start with a European option because it's simpler. Basically, and you will learn later that there's basically not much difference between a European and American option if the option doesn't pay dividend. Okay, risk-free 2%. Okay, so from this option we always think about options using a payoff diagram. Okay, so what happens at expiry? And it's very important to be able to draw a good payoff diagram, a correct payoff diagram, because a lot of intuition can be derived out of the payoff diagram. Okay, so note that we are talking about what happens at expiration. Okay, we are talking about European option. So on expiration, what happens when, from a point of view, let's say from a point of view of a buyer. Okay, so we have strike 50. Okay, let's start with 50 here. Spot 40. So imagine that you are a buyer. If the spot is somewhere, spot at the maturity at the end of 6 months is somewhere here, let's say 60. Okay, so how much do you make? You can buy from the seller this equity at the price of 50. Okay, but current market price is 60. So basically you make $10, right? Okay, so we have 1 point here. Okay, this is the spot price at spot price, and on this axis is the profit. Okay, so if the price is 60, you're making $10. What if the price is 70? And it's also very clear, you make $20. It's basically a distance between the strike price and the maturity spot price, so it's $20. So you can see it's a linear line that joins 50 to whatever the P&L is, depending on the spot price. It's a linear line, and it's exactly 45-degree linear line. Okay, why 45 degree? Because for every dollar move in the x-axis in the spot price, you make $1 in the profit based on the option. Okay, what if the price is lesser than 50? Remember that we have the right not to exercise. Okay, so we just simply let the option lapse, because if it's less than 50, why would anyone want to buy from the seller at price 50, right? Because you can always buy from the market at, say, 40, below 50. Okay, so this is in short a payout diagram of a call option. Call option basically means that the buyer option has the right to exercise to buy the underlying, and so this is basically all that you need to remember in terms of payoff, because the rest of the option payoff diagrams can be simply inferred from the call option payoff diagram. Okay, so we also have a put option where the buyer has the right to sell. Okay, so from this is basically the reverse of the call option. Is the payoff diagram looks like that. Okay, so this is to buy a put. This is to buy call payoff diagram. 45 degrees as well, because it's 1-to-1 in the x-axis and y-axis. And let's move on to the seller point of view. Okay, sell of a put is basically it's the reverse of the buyer's P&L, so you just flip this along the x-axis, just like that. So this is to sell put. Okay, and to sell call is also straightforward. Simply flip the buy call payoff diagram on the x-axis, so it's looking something like that. So this is sell call. Okay, so it's very straightforward, and it's important to be able to draw these diagrams, because when we talk about more complicated stuff like the Greeks and different forms of exotic options, we need to get this fundamental right. Okay, let me clean off this. So it's always easier to start off from the buy call payoff diagram. Remember that that this payoff diagram refers to what you get at expiration. Okay, so when we are measuring the premium of the option, it's always at the time before expiration, because you want to sell the option before expiration in order to place a bet, or you hedge, or you have directional view on the underlying. Okay, so you can imagine what is based on intuition, what is the premium like. Okay, if let's say we are now 6 months away from expiration and the stock price is, say, $5, what do you think will be the premium? How much are you willing to pay for the option, knowing that you are allowed to buy at price 50 and the stock price is at $5? It's very unlikely that you exercise this option based on some kind of intuitive forecasting, because you are at $5 now. It takes a lot for the stock price to move to 50. Okay, so basically the premium that you are willing to pay for this option is close to zero. Okay, it's somewhere above zero, not zero, because there's always a chance that within the 6 months it may move above 50 for you to exercise. Okay, so how about, let's say the stock price now is say 100. Okay, so you are making $50. You have $50 in the money. How likely are you going to exercise? You're very likely you're going to exercise, right? Because within 6 months, it's quite unlikely for the stock price to move below 50. Okay, and so the option price should be quite close to this line, because for every dollar that it moves in the x-axis, you are always able to profit 1-for-1 in a 1-for-1 ratio. Okay, so it should be quite close to this payout diagram at maturity, and it's above because there's always the chance that it may move even higher. Okay, so we have 2 points here. Basically, the premium is above the maturity payoff diagram. Okay, because there's still about 6 months to go, and there's a chance that price may move higher, okay, over the course of 6 months, and we are willing to pay a bit higher for the option premium. Okay, so it sits somewhere above the expiration payoff diagram. Okay, maybe I'll talk a bit about FX option, because it's something that confuses a lot of students. Okay, I just want to give everybody an intuitive explanation on FX option and draw parallel to let's say a simpler, more commonly explained equity option. Let's say, for example, we have FX option, dollar yen, okay, USD JPY. Okay, a normal quote for USD JPY is simply a number of yen per dollar. Okay, this is a typical quote for dollar yen, which let's say it's 115. Okay, 115 yen per dollar. Okay, per 1 unit of USD. So this is a typical quote for dollar yen, and let's say for the option, assuming that the strike is 120. Again, this is the spot, similar to the concept of equity. This is the spot, this is the profit. Okay, the idea is very much the same. The graph looks like that. Okay, because let's draw parallel for using this 115 per 1 US dollar to the stock. In this case is $40 per stock. Okay, so basically this $40 is the same as this 115, and this one stock is the same as this 1 US dollar. So now we are assuming a US dollar is some form of instrument that you pay some money for. Okay, so you are paying $115 for 1 unit of US dollar, the same as you are paying $40 for 1 unit of the stock. Okay, so the payout diagram is something like that, and the profit in the case of the stock, we are talking about dollars, right? $40 in terms of dollars. So the profit in the case of FX option is also in terms of the parameter here, the numerator parameter here. So this is in terms of the yen. Okay, so the profit is yen, and so assuming that what else? Okay, so the notional here is about stock. It's not talking about one stock. The notional here is also talking about 1 US dollar. Okay, so assuming that you are assuming you are buying a call option. Okay, in this case, when you buy a call option, you are buying US dollar. Okay, so we are buying US dollar. When you buy US dollar, it's like you are selling JPY. Similar for this case, when you buy a call, you are buying the stock, okay, and then you are paying the dollars here. So similar for the FX option scenario, when you buy a dollar yen, you are buying the US dollar, which is the denominator here, and you pay the JPY. So sometimes people will say, okay, when you buy a FX option, you are buying a dollar call, selling a yen put. It's the same thing. And when US dollar strengthen, let's say when it becomes 130 here, because you're buying US dollar, right, you can buy at 120, but in the market it's being quoted as 130, so you're making 10 yen dollars. Okay, so 10 yen dollars, which is corresponding to here. Okay, yeah, that's about all that I want to talk about for FX option, just to give everybody an intuitive illustration on what's the FX option. Let's next talk about the put call parity. Okay, just now I mentioned the payout diagram for a buy call. Okay. It's something like that. Assuming that at this strike we are short a put, okay, at the same strike, so the payout will be something like that. Both are 45 degrees. Okay, so clearly both the lines join and then they form a straight line. And if you recall, the payoff diagram of a forward is also a straight line. Okay, so assume that we are short a forward at K. Okay, the payoff is also a straight line, 45 degree. Okay, so a forward means that you, let's say, sharing this example, in 6 months time you can exercise this forward at price K. Okay, if the stock price moves to say 60, K is for 50, you make $10, right? Because you are able to buy this at $50 and then sell in the market at $60 and you make $10. So basically from this diagram you can tell that when you buy a call, and you sell a put, it's exactly the same maturity as a forward. Okay, so this is very intuitive way of understanding a put call parity. Oops. Okay, this is a very intuitive way of understanding a put call parity. And what is F? F is basically the price of the forward today strike at 50. Okay, strike at K. And the valuation of a forward, if you recall, it should be something like the value of the forward today based on, let's say today is somewhere here, S0. Okay, the valuation of forward today, S0, so this is the, if you strike the option a forward today, this will be the forward price that you will agree with the counterparty today without having to pay anything, without any cash outlay today. Okay, so this is minus k. Okay, so minus k will be the agreed upon strike price of this forward that you agreed previously. Okay, so this will be the payoff at the end of maturity, multiplied by discount this whole thing back to the current period. Okay, so this is the future, and then do a discounting back to the present. Yeah, okay, so this is the typical put call parity formula that I think most people are familiar with, which will reduce to S naught minus K E minus RT. Okay, C minus P. This is the payoff diagram that most people are familiar with. Okay, call price minus put price, same strike, is the same as the spot price minus the same strike, discount back to the present value. Okay, next I'll talk about the Greeks. I think I'll talk about this in the next lecture.